Many analysts and commentators have made the case for emerging markets based on better fiscal prospects, slightly less levered private sector balance sheets, and generally higher growth outperformance. So what I want to discuss today is less why there is a case for emerging market growth, but more what does that growth mean for emerging market asset classes, and in particular for currency. One of the things that investors should consider is how much of the return in an unhedged passive equity or a bond investment in emerging markets is due to the currency. And we have shown that at least a third and typically half of the return for a sterling-based investor comes from the currency.
Much of the reporting of investment returns does not strip out the effect of currency. So let's suppose an American pension fund has a really good year. And the consultant would say, well, that's because the property you bought have gone up and the equities have gone up. And we say, well, which equities? They say, well, all of them, domestic and foreign. I say, well, that's interesting. Let's look at the foreign ones. And they look at the foreign equities and they say they've gone up. I say, no. What's gone up is the dollar valuation of those equities. Why don't we pull apart the movement of the equity itself and the movement of the currency? And if, in fact, you've had a year when the dollar is weak, and they're about 1 year in two, you will find that a significant proportion, and often the majority of the return that comes out of their return of overseas assets comes from currency, and also negatively as well. So if they have a really bad year, or they might have a year in which the equities go up and the currency go down and they don't make money. So unless in their reporting that's clearly stripped out, it becomes invisible. And they say things like, they being the investor very typically would say, I'm glad I invested in the domestic market, not the foreign one, because the foreign hasn't done very well. What they really mean is the dollar's been strong. Now, they're two completely different statements.
One of the things that stands out in emerging market currency investment is that if you had been a local investor trying to access the local return in those markets, your experience would be very different to that of being an international investor when you have to deal with a currency issue.
We have about a 10-year history of most emerging market currencies. But if we take that 10 years, the performance of emerging market equities from a perspective of a developed market investor like the US or the UK has been very good. But about 40% of the total return that the investor would have got through investing in equities has come from currencies. He probably doesn't notice that. But if you strip out the components of that return, as I said, about 40% at the end of 2010 would have been accounted for by the movements of the currency. And we think that's not an accident.
Where does the return in emerging market currency come from? There is a wide body of theoretical and empirical research known as the Balassa-Samuelson effect that shows that countries on a higher growth path in terms of per capita income relative to other countries will also experience a higher real exchange rate appreciation. This operates through higher productivity, boosting domestic prices, and the currency is effectively the price of your money. That means the real exchange rate will go up over time.
So broadly speaking, your developed market currencies will be drifting down in relation to those currencies. I mean, they're cyclical, so it doesn't always happen, but generally. And so really what you need to do is to think carefully, or rather, let's say first, have reported to you what proportion of your returns comes from currency, and then think carefully about whether or not the risks you're taking in your underlying equities or underlying bonds are as well rewarded as the ones you're taking in currency, or vice versa.
Also, some of the best performing companies in emerging market countries are not necessarily listed. An investor investing in the public equity markets, not going through the private equity route, may not be able to capture those returns or that global revenue stream coming through those companies. A standalone approach to EM currency investment could be a better and more efficient option to capture the emerging market growth premium than a passive allocation to emerging market equity index, where the currency weights are not necessarily the optimal weights you want to have.
The risks are really very significant in currencies. I mean, very typically, just to give you an example, the average annual volatility of the currency markets is about 11%, maybe 12%. The average annual volatility of the equity markets is about 16%. So you're taking a similar order of magnitude of risks holding currencies, and for most currencies, most of the time, you're taking a 50-50 risk. They're not things that are going to naturally return you excess returns, unlike equities that will, unless you make choices about what you hold and how you hold them, which is where active management will come in.